Alright guys, today we're going to be going over Chapter 5, Accounting for Merchandising Operations. So I know you guys are thinking, sounds like a lot of work and it's hard and all that, but trust me, it's a lot more interesting than you might think because it deals with companies that we go to every single day, such as Walmart, Amazon, Target, all those companies. I'm going to be referring back to our notes here. So a merchandising company can be a wholesaler or a retailer. Either way, they're selling a product. They can also provide services to customers to provide revenues, but the key difference is that they provide a product as a part of their revenue source. Now let's take a look at the income statement. So in the past, when we looked at our income statement, we were looking at revenues minus expenses. But when it comes to a merchandise company, we want to expand that revenue minus expenses equation to take a look at how much profit we make when we sell the product. So I'll break this down a little bit. So now when we do our income statement, we're going to be taking our sales revenue and subtracting that from the cost of goods sold to get our gross profit. Then we can subtract the operating expenses of the company to get our net income. So basically the cost of goods sold is the total cost of merchandise sold during the period. Alright, so freight costs is next. So FOB stands for free on board, which tells the reader the invoice who owns the inventory. FOB will tell us if the ownership changes at the point of shipment or at the point of destination. So if the FOB term is shipping point, then ownership of goods passes to buyer when public carrier accepts goods from seller. And if it's destination, then ownership of goods remains with seller until the goods reach buyer. Freight costs incurred by the seller are an operating expense as well. Okay, purchase discounts. So 210 and N30 stands for 2% discount if paid within 10 days. Otherwise, the net amount due within 30 days. So 110 EOM stands for 1% discount if paid within the first 10 days of next month. And N10 EOM stands for net amount due within the first 10 days of the next month. Alright, so what if your purchaser is dissatisfied because the goods that they bought are damaged, defective, or just don't meet their specifications? Well, purchase return is for return goods for credit if the sale was made on credit, or for a cash refund if purchase was for cash. And purchase allowances may choose to keep merchandise if the seller will grant a reduction from purchase price. So it's basically just as if you were to buy anything at the store and you just didn't want it anymore, or if you wanted it but at a discounted price. Alright, so recording merchandise transactions. So this is basically everything you need to know. So record revenues when sales are made. Do not record the cost of merchandise sold on date of sale. Physical inventory count determines the cost of merchandise on hand and the cost of merchandise sold during the period. Record purchases in purchases account. Purchases, returns, and allowances, purchase discounts, and freight costs are recorded in separate accounts. Recording purchases of merchandise. So now we're on to the buyer. So purchases is a temporary account whose normal balance is a debit. So if you can see here in the illustration, on the basis of the sales invoice and receipt of merchandise ordered from the PW Audio Supply, Stereo records the $3,800 purchase as follows. So as you can see, they set it all up for you right there, the original purchase and the product. So that's what's being shown. And make sure you guys be careful not to debit purchases of equipment or supplies to a purchases account. Now let's talk about the freight costs. So the buyer pays for the freight. So when the purchaser directly incurs the freight costs, it debits the account freight in or transportation in. So for example, down below right here, if the Stereo pays public carrier company $150 for freight charges on its purchases from the PW Audio Supply on May 6th, the entry on Salk Stereo's books is as follows. So as you can see, we have May 6th on the side, we have our numbers all on the correct side, so we need them on. So like purchases, freight in is a temporary account whose normal balance is a debit. So freight in is part of cost of goods purchased. The reason is that cost of goods purchased should include any freight charges necessary to bring the goods to the purchaser. Freight costs are not subject subject to a purchase discount, and purchase discounts apply only to the invoice cost of the merchant. If someone were to return some merchandise, this is what it would look like if we had to set it up for a return entry. So let's say the stereo returns goods costing $300 to PW Audio Supply, and we have to prepare the following entry to recognize the return. So this is exactly what it would look like, and purchase returns and allowances is a temporary account whose normal balance is a credit. Here's an example of a purchase discount. So as we can see here, the 210 net is taking advantage of the discount for early payment. So we have our illustration here to show us that on May 14th, the stereo company pays the balance due on account to PW Audio Supply, taking the 2% cash discount allowed by PW Audio Supply for payment within 10 days. The stereo records the payment and discount as follows. So down below right here, you can see how they recorded everything, and the purchase discount is a temporary account whose normal balance is a credit.